Ladies and gentlemen, welcome back to the channel and potentially welcome back to the beginning of one of the largest short squeezes that some of you guys have ever seen for the broad markets, but more specifically for stocks that have a very high short interest that have been completely obliterated into the ground due to the hedge funds in 2022. Those are going to be the ones that perform the best during this rally that I think is going to happen over the next couple of weeks. And this video we're going to play here in a minute or two from this woman on CNBC really breaks down in a very easy way for everyone to understand. And I could say it myself, but I don't want to steal her words here. So we're just going to play the 45-second long video. But she essentially says that hedge funds have been so weighted to the downside. They've shorted so much into the markets in 2022 that to even get to a neutral level, meaning that if the markets go up, a hedge fund's going to make, let's say the markets go up 3% a day, hedge funds are going to make 3%, whatever, neutral. If the markets go down 2%, they're going to lose 2%. Even to get to that neutral level where they're not so weighted in these short positions is going to bring the markets up a substantial amount, possibly 10 to 12% even from here. So we're going to talk about that. A couple other key things that I do want to talk about is not the fact that Michigan State lost to Michigan. God damn it, grab yourself a good old bottle of wine for that one. It's not that. It's that hedge fund redemptions reached an unusual high in September. This article just came out, and I do want to highlight this to you guys because there is a little bit more fear going on, at least with larger money in these hedge funds, and maybe they think they can get a better return by themselves. Whatever the case is, we're going to talk about exactly what is said in this article. And then this, the Federal Reserve pivot is coming in December. Here is proof. So we're going to talk about how hedge funds are actually positioning, why I think this rally is going to happen, what kind of effect it could happen on or have on stocks such as AMC.
We talked a few weeks ago, we thought it was very dangerous to be too short or too negative in this market, simply because we got so oversold, moving too far, too fast to the downside, and it meant that we were really primed for some kind of relief rally. And then to see the market rally so much on today's kind of very weak news from the tech names showed you that there is still more buying, still more positioning to kind of get just back to neutral after people got so short. So we think that this rally could continue. First level to get through is to 3,900. We have to break through that. That's very important. And then the next step is that 200-day moving average, which would be about 4,100. But then stocks are pretty expensive there.
Yeah, it looks like we are going to, we're still settling out, of course, but we're at 3,901 on the S&P. So we're right at that line.
And just for some of the actual numbers here, this says, and this was posted on August 18th, I'll go ahead and read this paragraph from Google. It says net short positions against the S&P 500 futures by hedge funds have reached a record 107 billion this week, according to calculations by Greg Butel, head of U.S. equity and derivative strategy at BNP Paribas. Now, what's important is August 18th, because that is the last major rally that we had, right? This was back in August. Literally, this week was where the S&P went up about 3.5% alone this week. And a lot of that shorting was done around the 200-day moving average. And you can see what has happened to the markets since August. It has been pretty much straight down. So I imagine the current data on this is going to show a lot more short positions than what we even had back in August. And to even get to a neutral plateau of longs and shorts for a lot of hedge funds, you're going to have to see a lot of buying, because at this point, when the Fed is involved and there's rumors about the Fed slowing down the pace of rate increases, and people such as, or entities, I should say, such as the Bank of Canada has already done this and just last week surprised the markets with a smaller rate hike. Things like that make it more probable for it to happen. And if that does happen, well, the pace of rate increases has slowed. And as long as inflation stays okay and the labor market, starts to cool off a little bit more every report, well, that's going to be a very bullish thing for markets. And you quite possibly have seen the bottom. Now, it does depend on fundamentals, what happens with the dollar, what happens with the bonds, obviously what happens with inflation and the Fed. But at this point, I think you could see an even more substantial rally than what we've seen in August and break out of the 200-day moving average if the Fed does give us that small swivot. I wouldn't necessarily call it a pivot because the Fed's not going to be cutting rates anytime soon, but the pace of rate increases will be smaller, and that is something that the markets are going to eat up. And we will know what the Fed is going to do by next Wednesday at 2 p.m. That is the FOMC meeting. They're going to probably raise rates by 75 basis points. That's what the markets are expecting firmly, but with about an 82.2% probability, still a 17.8% probability of a 50 basis point rate hike. But the Fed usually doesn't budge from what the futures market is pricing in for the Fed. They usually like to go in line with what the markets are expecting. Now, that is very, very bullish as long as the data supports that the Fed should do that, because right now, as of today, October 29th, it's about to turn to October 30th as we are filming this video, for the December 14th Fed meeting, 48.2% of market participants are expecting a 50 basis point rate hike, and only 43.4% of market participants are expecting a 50 basis point rate hike. There's even 8.4% of market participants expecting a 25 basis point rate hike. And this is done through the federal swaps, right? People are betting on where the federal funds rate is going to go by these next meetings, right? So that's kind of what the Fed goes off of. And as of right now, it's looking pretty damn bullish. And obviously, I say this because we got through earnings season. A lot of companies did not so good. A lot of your large tech stocks did not do good. A lot of them guided down, but the markets were still able to hold up. And I think at this point, they're becoming a little bit more comfortable with those valuations, even when growth is slowing down. And this rally could be short term, or it could mark an actual bottom if inflation comes down. It's all going to obviously depend on the data. But throughout the next couple of weeks, we also have the midterm elections. And historically, in a year where the stock market is down in midterm elections, the fourth quarter rally, the Santa Claus rally, is usually a lot more aggressive. And there is a lot of statistical data on this that you could actually pull up different points. But the long story short of anything you'll pull up is the Santa Claus rally is where most of the gains for the actual year is made. So if we're heading into the start of the Santa Claus rally, the start of the fourth quarter rally, well, that's going to be very, very good. And it's going to be particularly good for stocks like AMC. And we'll take a look at the Ortex data on them just in 1 second. But I also do want to highlight this article. It says why the Federal Reserve pivot is coming in December. It says the Federal Reserve's barrage of 75 basis point rate hikes can only continue as long as monthly employment reports continue to show solid job gains. It's politically unacceptable for the Fed to cool an overheating job market, but jumbo rate hikes won't fly when the job market has already lost steam. It says the Federal Reserve will pivot after the October jobs report. It says a fourth straight 75 basis point rate hike looks almost certain on November 2nd, with no more big economic reports between now and then. But odds of a fifth straight supersized hike on December 14th, now at about 65%, according to CME's group Fed Watch page, are too high. It says that's because we're almost guaranteed to get a weak October jobs report on November 4th. And it says through the first 9 months of the year, seasonal adjustments have boosted private payrolls by 851,000. That's 500,000 extra jobs compared to the average impact of seasonal adjustment through September from 2013 through 2001. And you guys can see the job market right here, basically saying that with the seasonal job gains, you're pretty much guaranteed to see the job market cooling off in a big way. And I am along those same lines. A lot of people's personal jobs, I mean, look at the earnings reports out of a lot of companies. Pretty soon here, they're going to start laying people off or giving, people less hours at that. And that is going to solidify the Fed's case for slowing down the pace, not cutting rates, not stopping raising rates, but slowing down the pace. That's all the markets care about, is what's going to happen over the next 3 to 6 months. If the pace slows down, that is going to be very good and potentially lead to less volatility within the Fed and within the bond market. And that's something that the stock market is really going to like, because after all, bonds have done nothing but go down. The yields have done nothing but go straight up throughout 2022, and you're really getting to that 4.5% peak that looks to be a very high level, and should attract some people to the bond market if they do expect smaller rate hikes to come. But nonetheless, let's talk about this article just briefly. It says hedge fund redemptions reach an unusual high in September, and it says net hedge fund outflows reached 21 billion in September this year, almost twice as large as the September average from 2014 through 2001. And basically why I highlight this is because where the hedge funds sit as far as their actual shorting activities is very interesting with these large net outflows in September. Think about it as your portfolio. If you have margin on your portfolio, you got a $10,000 portfolio, you got $10,000 worth of margin. If you put that $10,000 of margin into an option trade and you blow that up, well, now you're at a 50% margin ratio, right? Because if you had 10,000 of actual money in your portfolio, you had 10,000 of margin, you didn't use it, you still technically don't have any margin used. You spend 10 grand, you're going to be substantially in the toilets, right? Same thing with these hedge fund redemptions. If the positioning doesn't change in a hedge fund's portfolio, but they have to start paying out this money, it's essentially the same thing as losing money on an options trade, or just losing money in general. It really helps to get you to get out of your positions. And at this point, it looks like a lot of short positions would be the ones to actually go in this market environment, given we're closer to the end of the Fed raising rates than the beginning. And I think stocks like AMC that have 20% short interest know they're not going to rally overnight, but they'll probably start to rally if we do get that Fed swivel, that Fed slow down to 50 basis point rate hikes. And that's because we kind of need a catalyst for some of these, lower fundamentally sound companies, which AMC's a lot better on a valuation perspective today. You could make a very strong bullish case, I think, for the valuation for AMC, especially as competitors have been going out of business. But still, once you get that actual catalyst, that's when the sentiment will change in the marketplace. And that's where people are going to look at AMC not as a stock that only goes down, but as a stock that could potentially double or triple from here. And I think that will start a lot of momentum in some of these very, very shorted stocks. I think it would be crazy to think that on the day that the Fed, does give us that pivot, they do slow down the pace of rate increases, the stock would be up 20, 25, 30, 35, 40%. I think that is definitely in the cards here. And I think with this valuation, AMC at $6, it makes a lot of sense to go long here, even with some longer dated call options. That's my personal opinion. That's probably what I'm going to do with my portfolio. Don't listen to me. Come to your own conclusions on that. But as far as Friday, you've seen 6 orders totaling $118.42 thousand on AMC stock, with a positive order value of 60%, with a short interest sitting at 19.68%, a cost to borrow max at 20.14%, cost to borrow average at about 14%, and the days to cover creeping ever so close to that 5 days, and the utilization is still at 100%, guys. So I think you guys get the drift of this video. I think it's going to be very bullish, even on a technical basis on the S&P 500. I think that woman on CNBC is very, very right, and I do think if you get a Fed slowdown, the markets can see a little bit of multiple expansion here. The actual price of selling price of stocks, I think that could go up, and that could even boost us past the 200-day moving average, at least back to the levels that we've seen in August, guys. So that is going to be all for this video. I think there's a lot more potential here for the markets to go up than to go down. I could be wrong. Come to your own conclusions. I'm not a financial advisor, but if you guys do want to come trade with me live in real time, baby, link down below in the description of this video. Nonetheless, I will see you guys in the next one.